You spend most of your waking hours working for your money. But if you are like 90% of the population, the moment you go to sleep, your income goes to sleep right alongside you. The traditional financial advice we are fed is simple. Work hard, pay your bills, and lock whatever is left over inside a safe savings account. Look at the mathematical baseline. Today, a standard bank account pays an annual yield of roughly 6 to 10%. But map real-world inflation next to it. The actual cost of living rises at 14 to 16% a year. We see this every time we buy rice, lentils, cooking oil, or pay at the pump. The prices climb relentlessly. Leaving your cash locked away in a bank is mathematically a system that slowly makes you poorer. Every year, your money buys less. The internet loves to sell a highly specific cure for this, the dream of passive income. The reality is much harsher. Earning money while you sleep requires a massive, upfront, painful tax. This matrix shows the two currencies you can use to pay that tax. You either pay with liquid capital or you pay with sustained sweat equity. We are going to ruthlessly evaluate 5 popular wealth-building vehicles and plot exactly what they demand from you on this board. The reason people fail to build wealth is a failure to match the resources they actually have to the right strategy. Let's look at the bottom right of our chart. This territory requires high upfront capital, but very little of your time. Your money does the heavy lifting. The default vehicle here is the stock market, but you don't need to be yelling on a chaotic trading floor. By simply parking capital into broad index funds, like the Nifty 50, you capture the long-term growth of top companies. Over decades, these have returned 15 to 20%, comfortably beating inflation. Then there is commercial real estate. You likely can't buy a skyscraper, but you can buy a small fraction of one through a real estate investment trust, or REIT. By holding these shares, you receive rent-like dividend payouts every few months, without ever having to fix a leaky roof or chase down a tenant. Plotting these on our matrix, index funds and REITs manned firmly in the bottom right. Here's the trade-off. These vehicles are truly passive, but without significant starting capital or 30 years to wait, absolute wealth generation is painfully slow. If you want a true asset that outlasts major market crashes and currency collapse, we look at gold. But buying gold jewelry is a terrible financial decision. The moment you pay the 15 to 20% making charge, a massive chunk of your capital evaporates. The correct utility is systematically accumulating digital gold, pure coins, or raw bars. On our framework, gold sits low on effort and moderate on capital. Gold does not act as a high-growth compounding engine. Its specific job is to lock in the purchasing power of the money you already have. If you are starting with an empty bank account, you have to look at the exact opposite side of the board. You must acquire a high-value skill: coding, digital marketing, video editing, or copywriting. A physical vault can be emptied, markets can crash, but a monetizable skill is permanently locked in your head. You then scale that skill by building digital real estate, YouTube channels, blogs, or online courses. The cost is extreme. You will spend a minimum of 6 relentless months working entirely unpaid before the market gives you any financial feedback. Look at where skills and content creation land on our matrix, the extreme top left corner. Maximum effort, zero capital. Eventually, these generate highly scalable income, but calling them passive on day one is a lie. Surviving the upfront sweat equity is a brutal filter. Knowing these assets is useless unless you actively match them to your actual life constraints. This flowchart asks, what is your most abundant resource? Have cash but no time? Follow the right branch, automating cash into index funds, REITs, and gold. Have time but no cash? Follow the left branch, deploying hours into skills and content. Total failure happens when you cross wires. A broke student cannot rely on index fund dividends, and an exhausted professional cannot burn midnight oil editing videos. Here is the immediate timeline. Spend the next 2 months strictly tracking every expense and isolate a non-negotiable 10% savings rate. This pie chart shows the breakdown for months 3 to 6. Dedicate 50% of your effort to skill building, put 30% of your capital into the market or gold, and keep 20% in the bank for emergencies. Do not try to day trade or hunt for overnight returns during this phase. The school system trains you to work a job, stash cash in a bank, and slowly grow old. In modern economics, that math no longer works. Actual wealth is built through highly organized systems that protect your capital from systemic decay. You cannot skip the work. You must decide today to deploy your time or your money, because leaving both idle guarantees you will be left behind.